sometimes entertaining content, please consult your investment professional, financial advisor, or better yet, speak to us before making any decisions discussed in today's presentation. And don't forget that this is a live presentation, so please log in and present some questions to us along the way so we can answer them. And if you're listening to this at home, please feel free to head over to our webinar page to participate in that. So our presenters today include myself, Tim Fuller, a certified financial advisor who's worked with hundreds of clients over the years, helping to make the complex simple for companies such as AMP, Mercer and independent advisories. We also have David Llewllyn Smith, co-author of The Great Crash of 2008 with Ross Garnaut, founder of the internationally acclaimed Diplomat magazine and now chief editor of the enormously popular Macro Business blog. And finally, we've got Nucleus Wealth's head of investments, Damien Klassen, whose 25 years in the world of finance has seen him as founding partner and head of research at analyst firm Aegis Equities, head of quant strategy at Wilson HTM, and was responsible for mining, energy and big data in the $60 billion global quant fund, or equity fund at Schroders. For more information, please see our people section at www.nucleuswealth.com. So today we've got our next instalment of Nucleus Insights, and today's topic is, has the Australian dollar peaked? And so I'll hand over to, we'll just jump into just quickly our agenda for today. So what we're going to be looking at, of course, is the Australian dollar. Is there a fair value model that we can apply? The US dollar dynamics and some discussion around that. And is there an upcoming year of two halves for the Australian dollar, and a little bit of evidence to support that this may be the case as well? So on that note, I'll hand over to David. If you'd like to kick us off with the first of five drivers. And of course, we're looking now at Australian and global growth. So take it away, David.
Thanks very much, Tim. So at the MB Fund, we use a fair value model for the Aussie dollar that has five drivers, and I'll run through those quickly for you. The first one is relative Australian and global growth rates. Like the Australian dollar tends to rise when global growth is strong, the logic behind that being rising commodity prices. And the chart you can see here, the trade weighted index versus the terms of trade. The terms of trade captures those rising commodity prices versus import prices as a ratio. The trade weighted index is the Aussie dollar plus inflation rates, more or less. And as you can see, the relationship between the two is quite strong, especially since the float. It's certainly very strong in trend terms, although sometimes the degree of relationship can be influenced one way or another. But that's the first of our drivers, and it's one of the two of strongest. The second, and equally strong, I think, is relative interest rates, and that is the gap between the cash rate in Australia and other jurisdictions. In this case, we're looking at the US dollar or the US cash rate. As you can see from the chart, during the mining boom, we had immense peaks where, there was a huge interest rate uplift in Australia versus the US, and that drove a lot of capital into the Australian dollar to capture that yield, as well as the rising currency. But since 2011, when the boom peaked and started going bust, slowly but surely, that uplift is actually now completely inverted over 6 years, and we've now got across the curve a negative yield in the Australian dollar. That is, for someone to borrow in the US and to buy Australian assets, they have to actually pay money. So at the moment it's roughly even on the 10-year. It's about minus 20 basis points on the 5-year, and it's minus sort of 14 or 15 basis points on the 2. if you go back in history and look at the chart on the left-hand side where these relative interest rates went negative last time around the millennium, you can see that the Australian dollar, there was the period of the Australian dollar falling below 50 cents. So this is also a very powerful driver of the value of the dollar. So third one is sentiment. And this chart here is the net speculative positioning from the CFTC. But above the line is when sentiment is strong and people are buying a lot of long US dollar contracts, and below the line is the inverse. At the moment, we're close to neutral, but sort of modestly bullish. So, on this one, this driver at least at the moment, the sentiment, Australian dollar, you could say, is mildly in favour.
Mm-hmm.
I should just go back and say on the first two, the terms of trade are strongly in favour of a firm dollar. Whereas the interest rate spreads are strongly in favour of a weaker dollar.
Right.
This
Weaker Aussie or US?
Aussie dollar.
Weaker Aussie dollar.
Not
Okay.
US.
Yep.
And this third one, of course, is sort of roughly neutral, modestly bullish. Our fourth one there is technicals. And, this is more of a short-term mover. It's for all the traders out there, but basically it's still relatively bullish as well. The Australian dollar's been rising since early 2016. In a steady channel. It's got what they call an ascending triangle breakout underway, which suggests, possible further upside. Having said that, the downtrend, the longer-term downtrend since 2011 isn't broken either. So, the Aussie could go somewhat higher yet before actually violating a sort of a more dominant downtrend. But for the time being, that's also bullish.
Okay.
And then the fifth driver, when we're talking about the AUD USD, is obviously the relative strength of the US dollar. And at the moment, as we know, that's very weak and has been most of last year and still is today. That's captured in this chart where I've compared the DXY, which is the US dollar index, which is a basket of currencies versus the US dollar, which gives us a glimpse of what its sort of overall position is in terms of strength, versus the particular strengths and weaknesses of that currency versus the AUD. And the blue line is the contribution of the US dollar to the cross, and the orange lines are the contribution of the local. As you can see, the Aussie dollar's had a little bit of strength, but overwhelmed by US dollar weakness in that far right-hand bar, where the blue line is dropping much faster than the orange line is rising.
Sure.
So, in other words, this is actually a battle of two weak currencies.
Okay.
The AUD is deteriorating against the US dollar, but the US dollar is falling faster.
Faster? Yep, sure.
And if you look at the AUD on the other crosses, you can see that it's like against Euro in particular, it's still trending down and has been for quite some time. So, that's, I guess, a wrap on what we see as the five drivers that input into fair value in any given point.
Yep.
So at the moment, the summation of those five is net bullish.
Okay, sure.
I think 4 of the 5 are bullish.
Yep.
The two big ones are the first two, which are sort of relatively offset one another.
Okay.
In high commodity prices, but low yield spreads.
Yep.
So for the time being, the currency is certainly supported, and we'll kind of I guess turn to a discussion of how the weak US dollar is now determining that path.
Okay, sure. So we'll look at the US sort of side of things first.
Yes. We'll come back to that's sort of the short-term outlook. I guess you could say that it's got strength and some bullish dimensions.
Yep.
I'm going to then turn to the outlook in a moment, but first I want to just kind of wrap up why the US dollar is so weak.
Okay.
And how that will influence the weak Aussie as well.
Yep. Sure.
So there's a very hot debate going on at the moment on why the US dollar is so weak, given it's in this rather unusual position of being both the largest funding currency in the world, and by that I mean people tend to borrow in US dollars to then distribute capital around the world. So this is the carry trade from the US into emerging markets.
Sure.
But it's also in this strange position now of being the high-yielding currency, where its interest rates are rising faster than anywhere else. So there's this hot debate on why one is overwhelming the other. And at the moment, obviously leading up until last year, the dominant factor was the rising interest rates, and the US dollar was rising. But now, as US growth is really churning along, it's gone the other way, and it's falling. Now, it's very hard to be definitive about this, but my view is that number one is the dominant factor here. That is, strong growth in the US tends to lift all boats.
Sure.
And people start chasing risk, and so they take those borrowed US dollars and they just stick them offshore.
Okay.
Especially in emerging markets, and there's a double uplift when you buy commodities as well.
Okay.
Because they're priced in US dollars.
Yep.
They're also very associated with emerging markets growth.
Yep.
And so you get both a monetary tailwind as the US dollar falls and the commodity price rises, and a fundamental tailwind as the emerging markets get stronger.
Sure. Okay. Makes sense.
But there are other factors. There's the Trump stimulus in its various forms, and some are arguing that it's definitely going to create a long-term weakening fiscal position, which may be undermining the US dollar at this point. Strength in Japan and Europe, where they're sort of further behind the rates curve than the Fed.
Okay.
Personally, I think they're going to stay there, but there's certainly some capital that thinks that they'll be forced to tighten as well. Speculative positioning is chasing this trend really hot. You can see that in all the CFTC data with kind of record longs for Europe and record shorts on the USD.
Okay.
And then the fourth one that we thought would be bullish is turning out to be only mildly so for the US dollar, which is tax repatriation. I might just give this one to Damo because he's been looking at this more closely.
Okay. Welcome, Damo.
Yep. Thanks, David. Look, I think the key thing with the tax repatriation is that what we're seeing is the companies, the way the legislation has actually evolved is that the companies often already have the cash within the US economy. So it's not as sort of a matter of saying you've made these profits in this Dutch or Irish sort of entity, and the money is sitting in that entity and it's going to come back to the US. Because what's happening in many cases is that money is actually already back in the US, in US Treasuries or something like that. Basically, the way the legislation works is that under the old legislation, you couldn't use the money to buy back your own shares. You couldn't use the money to stick in your own the company's bank account. So let's say it's Apple, they couldn't buy back Apple shares. They couldn't use the money to stick in the Apple bank account. They couldn't use the money to pay down Apple debt. But they were fine for that entity to invest in US Treasuries or US bonds within the US market. So they're not actually running a lot of the money's already back in the US. They're not running sort of currency risk or anything like that. And so now it's just a matter of the money being sort of transferred from one hand to the other hand, so to speak, and it's not a sort of a big influx of money back into the US by and large.
So essentially, it's an accounting repatriation as opposed to a physical repatriation.
Absolutely,
Yep,
yeah.
okay.
And so there will be benefits in terms of that money coming out of probably lower risk assets and going back into either buybacks or reducing debt for these companies. But
they're not buying dollars.
They're not buying
to do that.
Yeah,
Okay.
In general.
Sure thing. All right. Thanks, Damien. Anything else to add on that one, or we'll move to the next one, David?
We can move on to a bit of a wrap if you like. This is looking forward now, basically.
Sure.
On how these various forces are going to play out in the second half of the year. As the US dollar falls, it's obviously building this incredible boom into the US economy, which Donald Trump's going to be very happy about.
Mm-hmm.
They'll now have still quite loose monetary conditions, huge fiscal spending,
Mm-hmm.
Tax cuts, and a crashing currency.
Yep.
So
exporters happy.
yeah, and you can see all of this playing out, in the leading edge of the ISMs. They're all going nuts, including manufacturing now as the dollar tumbles, and it also has the tailwind now of shale.
Yes.
Shale, because as the US dollar falls, the oil price rises, and that stimulates shale activity as well. So the question is, what causes this to reverse? The key for me is that at the moment we have just sort of a wild monetary play on all these trends, where the falling US dollar just creates all of these flows into risk assets, and that then translates into higher markets and actual fundamental growth as well. However, this next chart, Chinese broad credit, as you can see, it's been slowing and falling now for a good 12 months, and if anything, the slowdown is accelerating.
Mm-hmm.
Now, China is 50% of consumption of just about every commodity that you can name.
Mm-hmm.
As we've already discussed today, a lot of those commodities are associated with emerging markets and emerging market growth, both as production and consumers.
Sure.
And we've got this flow of capital out of the US into these emerging markets as well, based on US growth and its monetary effect. However, you have China about to slow. We don't think it's going to fall off a cliff, even though that credit chart looks like it could go the way of 2015 pretty quickly.
Yep.
If you look within the slowdown, the composition of credit slowing this time is different. It's a little less fluffy and a little more like the remaining strengths are more fundamental than they were in 2015.
Okay.
That is, the credit is slowing in areas that are less investment intensive.
Right. Yep.
So we definitely see a material slowing, but not as bad as 2015. But slow enough for it to damage sentiment and real growth in emerging markets and economies.
Okay.
And so obviously this is going to clash headlong with the current rush out of US dollars and into emerging markets. So the second half, basically, we see going from this one-way flow of US capital outwards.
Yep.
To the monetary effect of that tailwind hitting the headwind of fundamentals.
Okay.
As Chinese growth slows
yep.
and pulls down emerging markets.
Yeah, sure. Okay.
So the question is, what happens then? I mean, you still have an outrageous US boom, but at the same time, a lot of it is temporary because a lot of it is stimulus based.
Yep.
And so, by mid-year markets, I'm sort of starting to look forward at 2019, wondering what's happening with US growth, and it's very likely to be slowing.
Okay.
It'll still be good, but likely to be slowing as the Fed tightens. And so there's a reasonable argument to make there that the US dollar will have run its course and may well turn around. That's the first impact of these forces. The second one, of course, is that the Chinese slowing will play out in individual ways in individual currencies, and it will be particularly harsh on the Australian dollar. That means, or the reason for that, if we think back to our first chart, as one of the primary drivers of the value of the dollar, the terms of trade,
yes,
it will fall a lot, or it should fall a lot as China slows, as iron ore and coke and coal correct.
Yep, sure.
And so that's the primary driver keeping the Australian dollar high at the moment, and it should come off fairly materially through the second half. This assumes, of course, China doesn't immediately re-stimulate.
Yep, and fire it back up again.
But it would be silly of it to do so, given, it's surrounded by improving global conditions, and it is actually an opportunity for it to rebalance.
Yep.
Rather than take further financial risk and ramp up credit again.
Sure.
So assuming China persists with that path, and all the signs are that it is at the moment, then bulk commodity should come off, and at that point, your fundamental support for the Australian dollar will weaken dramatically. Now, that's going to weaken into the crashing yield spreads.
Okay.
Which is, as we were talking about earlier, you have...
it's an interesting new paradigm that we see ourselves in.
Yeah, well, I mean, this plays out in this last chart, where you have the yield spreads is the orange line, and the AUD US dollar is the blue line. Now, if you look at that chart closely, you'll see in trend terms they have always followed one another. Like the terms of trade, they haven't, the degree of relationship has ebbed and flowed, but the relationship's never broken.
Sure.
They've always followed each other in terms of trend.
And what you mean by that, David, is that when the spreads are high, so the interest rates are much higher in Australia than what they are in the US, that the Aussie dollar's high, and vice versa. When the spreads are very low, that's when the Aussie dollar versus US falls.
So they move in lockstep, essentially.
Correct.
Up
they
until
do. That is until 2 years ago.
Yep.
The first time since the float of the Aussie dollar, the two started to diverge in trend terms. And that was when the US dollar kept going up for a little bit, but it started to show a bit of weakness. But more importantly, the Chinese stimulus just revved up Australia's terms of trade much more than anyone else's, because it was very focused on building infrastructure and housing.
Which is what we supply.
Yeah, so it was iron ore and coal. So the point is, if you take out that commodity support, you are left with the crashed spreads.
Yep. Okay.
And so if those two things come together, because those spreads are probably going to continue to deepen, like go further negative as the Fed tightens and the RBA doesn't.
Yep.
Then you're creating a recipe for a very rapidly falling Australian dollar.
Fascinating.
So, if that were to also combine with a turn in the US dollar, then it'd be very swift indeed. But basically, this is why we've sort of coined this discussion as the year of two halves, where you have a strong Australian dollar trying to fall through the first half, but held up by the US dollar and commodity prices.
Yep.
But slowing China changing that formula and dynamic through the second half, and triggering, material falls in the Aussie.
Yep. Okay.
And it's worth noting as well, some of that weakness in the US dollar which is the part where there's been a lot of debate about, which is quite confusing at the moment. What David's sort of expressed and we're sort of playing in the portfolio is it's really a tug of war between two forces. One is investment out of the US, mainly into EMs, a little bit into Europe, but mainly into EMs. And the second part is the higher yields in the US attracting cash back in, and the higher growth rates and higher inflation sort of flowing through to those higher interest rates that attracts money back in. And so at the moment, it's been that EM's been the winner, that the money's been headed out.
Yep.
But if at a certain stage, if yields rise to a certain level, and especially if China does slow, then we see that reversing as well. So that's what David's talking about. And there's not a good, we don't have a date, unfortunately for you on that. And
it is tough.
And a time, yeah. It's not something where and as David said, when it turns, it's going to turn quickly. And so it's not the type of thing you can say, yeah, I sort of agree with that. I can see where that this is likely. Give me a call on the day, and I'll
adjust the portfolio.
Yeah, exactly. I'll stick some money in, and off we'll go. Type thing. This is the type of thing, unfortunately, you just have to set your portfolio up for, and because there is this tug of war going on, and when things change, we do expect them to flip quite suddenly.
Yep. Fantastic. More to the point, and active management as well. Okay, so I guess just as an overall outlook, and I'll hand back over to David, but I'll just forewarn Damien we'll be looking at some investment impacts and allocation thoughts as well at the end there. In a nutshell, I guess, David, you're saying essentially we've got the prospect of the US leveling off perhaps over time? The weakening's going to sort of effectively be stemmed. Is that in the short term as we're talking about?
I think so. I mean, the recent volatility is interesting here as well because, I think partly what triggered the last few weeks of volatility in the stock market is the falling US dollar is clearly threatening to overheat the US.
Sure.
And so that's sending yields up really sharply. And so, there's a dynamic here where if the US dollar keeps falling, at a certain point it just simply sends yields too high too quickly and the stock market comes off. And then capital rushes back into the US dollar in a safe haven trade.
Sure. Yep.
So there's a sort of ebb and flow where, at some point that'll simply turn.
So it'll sort of self-stabilise perhaps to a degree.
Yeah, and there's some of that going on. I'm not sure if we're there yet. Obviously since then we've had nothing but buying frenzy in everything. Except bonds. So, yields are going to new highs and nobody cares.
Yep.
Even though last week it was the end of the world. Such as markets. And so, nonetheless, the appearance of that dynamic, of the tension between bond yields and stocks presents a conundrum for the US dollar falling, which will mitigate those falls, I would think, over time.
Sure.
I don't know if it's finished falling, but at some point I think it will. And if it's that, it's China. If it's China that does it, or it's actually the US just slowing itself.
Yep. Okay.
That does it, and it happens a bit later in the year, or the prospect of that slowing.
Okay.
As the Fed's forced to tighten harder than anyone expects. So yes, I would say it's closer to the bottom than otherwise. I'd be surprised if the Aussie can rise above its recent peak at 81.5.
Okay. Yep.
But there's, what are we? We're in Feb. There's definitely confusion coming out of China because of its winter shutdown regime.
Sure.
Which has muddied the data,
mm-hmm.
especially around bulk commodities, which are the key. And shutting down the steel mills has left people wondering what's that going to do with the early year build of stock, and will that be forced to roll further into the year, and then that would support commodity prices longer because steel prices will stay up. There's a lot of confusion around that. This is why I sort of say mid-year might be the trigger.
Before it sort of becomes apparent. Yep.
Yeah, because that's when I would expect it to be clear in Chinese data that it's slowing. But at the same time, Q2 is a very reliable seasonal down period for bulk commodities.
Wow. Okay.
The sort of April through June 3 months is very poor for iron ore and coking coal.
And we've sort of mentioned in previous presentations about the inventory levels. Do you think they're elevated inventory levels?
That's right, and that's where it becomes, potentially kind of overshoot areas where, if China does slow enough to liquidate some commodity inventory, then, that will overshoot commodity prices to the downside.
Mm-hmm.
And that's a plausible scenario later in the year. But you don't even need to go there to really sort of acknowledge that these bulk commodity prices are going to fall.
Yep.
So, it's a question of when all these as Damien put it, this tug of war, who wins what at which stage. And it's impossible to know. His point is absolutely the right one.
Yep.
You can't put a date on it. You simply got to set yourself up for it.
Yep. For
what you see coming.
Yeah, sure.
And it will inevitably, of course, go completely differently, and you won't know, what's gonna come when. But the overall thesis is strong.
Is the falling dollar is almost a certainty.
Well, there's nothing's a certainty in these things, but it's it's
There's
a
lot of
very
supporting
good
evidence.
It's a very good argument.
Yeah, sure. Okay, very good.
Yeah.
And on the topic of setting up things, I'll hand over to Damien just to give us a little bit of insight on what Nucleus Wealth is doing in terms of our portfolios, both locally and abroad.
Yeah, sure. So the issue I have is I wish the US was cheaper relative to Europe.
Sure.
So what we have been doing since about March last year is holding quite a large amount of European equities, with the view that that there was this push back into the euro, and that we could get exposure, much cheaper exposure in Europe, and sort of benefit from not having to buy stocks that were as expensive. As the year progressed, as the year progressed, what we tried to do was get more and more US exposure as the sort of boom, as this sort of Trump boom and the likelihood sort of kept ticking along. What we tried to do was find US stocks that were listed in Europe, or stocks with meaningful US exposure that were listed in Europe, so we could actually get part of the boom without having to pay up for the prices of it.
So effectively, just tapping US demand in cheaper markets.
Exactly.
Sure.
So now the question is, that we're, here we are, and then late in the year we sort of sold down a lot of our holdings, and sort of we're holding a fair bit of cash at the moment. So the question sort of here going forward is saying, well, do you go ahead and deploy this cash, or is it time to sort of go to the bunkers, and the markets have risen enough? And we're sort of still trying to walk this line about saying, well, we want to have enough exposure to markets that if the boom goes on for another 6-12 months or a little bit longer, that we're not sort of behind the sort of too far behind.
Yeah, sure.
And things will, other things will change, and you don't want to be sort of left sort of underexposed. But on the flip side is our trends are clearly headed in one direction. We think they're probably going to take 12 to 18 months at least to play out, and so they sort of all lead towards having a more cash, more bonds, and more international assets, and you don't want to be sort of stuck in the position where we've been sort of suggesting these trends are happening, but
not actually preparing for
not
them.
actually prepared for them. Exactly. and so something, you get a few shocks, and all of a sudden the rug gets pulled out, and things head the way we wanted, we expected them to. Is we need to have our portfolio set up for that perspective. So at the moment, if the US was cheaper, we'd probably be buying a bit of US on average.
Yep.
Unfortunately, the US market still is quite expensive relative to Europe, and so we're still trying to sort of dig the best we can out of Europe and Japan and some of these other peripheral countries. I think getting the exposure, we're still on the path of trying to get that exposure to the US. We do think, as David has mentioned, the euro has run pretty hard, particularly against the US, but also against the Aussie dollar. So you've picked up sort of some currency gains on that, and now we're sort of trying to roll out of those and find companies elsewhere where we can actually sort of protect some of, or sort of realise some of those gains, but sort of stay with this this boom going forward.
Okay.
And as I said, a lot of this is coming down to timing, and it's not something. It's something where these things are going to move a lot faster than you expect, and so it is about that. As the year goes on, we'll just be slicing a little bit more and protect. A little bit more protection. Take a few profits here, take a few profits there, and with the idea that our portfolio will be largely in place when we do see the slowdown start to really hit.
Okay, sure. And just finally, I think it's probably we'll have a quick look, based on the theme of today, at perhaps investing locally. So obviously we do invest locally, as much as it sounds like we're trying to steer clear of it. Yeah. Are there any sort of themes or sectors or anything that you're looking at to potentially, apply this overall feeling of the falling dollar in the local markets?
Yeah, so locally is tough. Depending upon which asset allocation portfolio, which tactical asset allocation portfolio we have sort of limits on we can't buy less, because we can't buy less than 15%, say, in our growth portfolio, 15% Australian equities.
Yep.
Because it's a portfolio for an Australian investor. It's a growth portfolio. There's a
long-term element to it as well.
Exactly.
Yep. Dividends.
And most people have Australian dollar liabilities going forward, so there's sort of that part. It's really been a struggle to find things that, and we invest in large caps as well. So that's our other constraint. So we're constrained by large caps. And so most large caps are either banks or banks and financials make up sort of 40-something% of the market, resources, property. So the three sort of key areas that we don't particularly like are the three biggest parts of the market.
That would be frustrating, I'm sure.
And so we're basically anything else.
Sure.
Anything else that's not horrendously expensive. We've been sort of quite... we've had a big play on foreign... on companies with foreign... Income.
Yep.
And companies that have operations overseas. Most of those are very expensive, and it's very hard for us to buy any more of those, and we're just sort of slicing a little bit off the top every now and again from some of the most expensive ones of those.
Sure. Okay.
But yeah, the trick for Australia for me is trying to avoid the blow-ups rather than trying to particularly chase
the winners,
because we don't think there's going to be too many winners. As this plays out, and so it's more just about protection.
It does sort of seem to be an exceedingly crowded market. The dollar exposed industrial and that sort of
absolutely
play.
just getting so expensive, and it is worth noting as well. Actually, we do get a lot of people who, especially expats, who are sort of looking at they've got money overseas and talking about when is the right time to bring the money back to Australia and Aussie dollar high and low, but then the thought, well, if they're going to bring it back and give it to Nucleus and we're going to go and invest it straight into international stocks, is they're paying both sides of a currency translation.
Yep, sure.
And so it is just worth noting that we can actually take that money straight into, so we can take US dollars, for example, or pounds or euros straight into the investment portfolio. So there's not actually, you're not doing any transaction. We're just using that money to straight go and buy the stocks within that, which does save you that sort of double effect. And also we trade at wholesale rates on the currencies. So that's obviously a big saving as well for people who are looking at money overseas, looking at this Aussie dollar. Do I bring my money back? Don't I bring my money back? When's the right time? It's
so effectively you can have an international investments housed overseas in your name, but with an Australian investment manager.
Absolutely.
Very good. Okay, so look, we'll finish up there. Thank you very much to David, our chief strategist, and Damien, our head of investments, for your fabulous words there, and certainly a lot to think about. I think there's the recurring theme of China can giveth and then China can taketh away seems to be quite common through the thoughts for the Australian dollar. We will move on just quickly to a little bit about us. So, of course, Nucleus Wealth and the Macro Business Fund was put together to help you get access to quality, well-researched stock analysis and superior macroeconomically minded asset allocation. We use technology to help us provide a service typically only available to high net worth and sophisticated investors at a fee level that rivals the more basic solutions available to investors. We do this using our separately managed accounts, which allows clients to enjoy unparalleled transparency on what they own and why. It also means that each client effectively owns their own separate and discrete share portfolio, as we mentioned, managed by us, and we can accept foreign currencies. We've partnered with Linear Asset Management, who are backed by the ANZ Bank for cash management, and JP Morgan, one of the biggest banks in the world, as custodian of your assets. We feel this structure is the gold standard for your asset protection. We do also offer 19 separate screens, ethical screens, that you can use to help tailor your investment to ensure your money is being used to support companies that deal in areas and practices that you feel are important. By eliminating only the areas that are important to you, you keep the potential for higher returning areas that you might otherwise be ambivalent about, and these are typically ruled out in your broader ethical products available in the market. Finally, the name Nucleus comes from our ability to provide core holdings of a client's portfolio, allowing them time to explore areas that may be of interest or they may have experience in. We also offer a complete investment solution for those who don't have the time to coordinate their own investments. Our investment team has decades of experience in world markets, and we have access to a global team of stock analysts. By removing the layers of fees of middlemen that sit between your money and the markets, we have been able to reduce our fees and provide unparalleled transparency in the solution we provide. So for more information on what we can do for you, please call 1300 623 863 or contact us at www.nucleuswealth.com. Coming up next, so next week, stay tuned for Nucleus Insights 2018 to 2028. Where to Invest for Australia's Lost Decade. Really looking forward to this one, especially given the the stagnant wage that we've had, inflation that we've had, and the prospect of lower interest rates, and also, of course, the housing boom coming off over the next few years. So same bat time, same bat channel, Thursday the 22nd of Feb at 12:30. And if you'd like to register your interest, head over to proton.nucleuswealth.com and book yourself in so we can send out some emails and reminders. Fantastic. And just finally, thanks for attending, of course. Please complete the survey if you have registered for your attendance that we send out. Obviously, gives us a bit of feedback on today, how we've gone. And also, you can provide some insight into some areas that you'd like us to have a chat about and do some research on. So feel free to please flick an email through, or you can also directly send a message through to webinar@nucleuswealth.com as well. So on that note, thanks very much for your listening today, and we look forward to catching you at the next one. Cheers.